Welcome to our investment review and outlook. I'm Ben Hockema, and we're going to talk about the third quarter update. So let's jump right in. The topics we're going to talk about today: performance year to date through the end of the third quarter. Talk about some of the key headlines that I see out there in the investment markets, and then some reasons to be bearish or why you might want to be a little bit worried, and then finish with some reasons to be bullish because there's two sides to everything. So where we want to start, let's jump right into Q3 performance. So this first chart is just looking at just from July 1st through September 30th. And so we've got a couple different things on here. So the purple, we've got the S&P 500. Then we've got NASDAQ in the peach color. Blue is the Russell 2000, which is small cap US stocks. Then we have a developed market index in green, and in pink is the emerging market index. Then we got bonds there in the brown. And then the best performer for the quarter was gold there in the green. So up almost 16% for the third quarter. And you can also see that small cap was the second best performer, up 11%. That has been a shift from what happened earlier in the year. So this will be very interesting as we see some more numbers. Some later charts I have to talk about small cap and how that might be breaking out as we look ahead. If we zoom out just a little bit, let's go to year-to-date performance. We can see all the same colors, same indices that we have, same ETFs, but zooming out for the year-to-date. And so you can still see best performer for the year, gold up through the end of September 30th. Gold is up almost 47%. The second best is developed international markets. So we're talking Western Europe, Japan, Canada, Australia. Those are your developed markets. And so that's up 27% and then 24% for emerging markets. So overall, really good year. Pretty much everything is up. I mean, bonds are even up 6%, which has helped when interest rates fall, which is what's happened so far this year. Bond prices go up, so that helps some of that performance. And you can see we're pretty far off those lows. You can see how they're right around Liberation Day. You had the bottom of the market, and so nice recovery since then, pretty much across every asset class. As we jump into headlines, obviously the one we got to start with is as of this recording on Wednesday, October 15th, we still have a government shutdown. This has lasted longer than the average shutdown. So the average is about 8 days, and we are well past that. But one thing that I want to point out here is if you go back historically, the S&P 500 basically is flat over government shutdowns. And so I'm not terribly concerned about what this means for the investment markets if this continues on a little bit longer. And you can see that it's a mixed bag. In some years it's negative. Sometimes when they're shut down, it's positive. Obviously, the most recent one, December 2018, up 10% over that period of time. So I don't really think there's a lot we need to do about it, but it is a headline that obviously we're aware of, and we've got a lot of clients that are actually directly affected by it. But when we're talking just investment markets, I'm not terribly worried about this impacting, at least in the short term. And as I said, we are at all-time highs. And so we've got S&P 500. These numbers are all as of January 1st, 2020 through the end of the third quarter this year. And so you can see S&P 500 is up 125% in the first chart from January 1st, 2020. Gold is up 150%. And then I've got Bitcoin and Ethereum just because those are headlines. A lot of people are talking about what's happened. You're at all-time highs on three of those. The top three, Ethereum is approaching all-time highs. So that's great. That's a good headline. We'd like to see all-time highs. Hopefully when you log into your portfolio, you see that you're up quite a bit. And we're going to talk what that means going forward, though, here in a minute. But I want to finish headlines. I mentioned this before, international stocks. So let's jump right in. International has outperformed so far this year. And so a couple of things have happened. Number one, we've talked about this many videos before, but the US dollar index is just the dollar value versus other currencies. And that has an impact when you're investing internationally, because when you're investing internationally, you're buying stocks in another currency, and then when you convert it back, the dollar matters. So the dollar has gone down about 10% so far this year, and it's right now at the 97.8 level. long term, there's a range between about 93 and 110. So we're right there in the middle of the range, lower end. But what that's done is actually help performance. But that's not the only story. So that's part of it. But when we actually zoom in a little bit more here at the bottom and looking at different areas on how they performed in dollar terms and then also in local currency, that's where you can see that it's not just a dollar story. So if I just level set where we are through the end of the third quarter, the US was up 14.6%. If I look at the all world index, that's the next spot that we're at, up 26%. If you take out the impact of the dollar change, you're still up 17%, which means as a whole, international has outperformed if you keep currencies the same. Now, EFA is developed markets. That has actually underperformed slightly. So the biggest change there has been because of the dollar devaluation. But if I compare to emerging markets, the biggest reason that's outperformed is actually because of local currency. So, or local markets. So when I add all that up, there's both the dollar story and overall markets have done really well and companies are making money regardless of where they are. And so it's not just a dollar story. This is important as we look ahead because the dollar does have kind of a range bound. It might not drop too much further. But if we still have local performance does better, then you don't need the dollar to produce this tailwind to help as much because you're still getting companies to do really well. So I'm not worried about international underperforming because of where the dollar's at or anything like that, because you are seeing some nice growth in companies. As we look ahead, let's start with the reasons to be negative. I think we all naturally jump to some conservatism, and that's human nature to be worried about what could go wrong. But again, we're going to finish with reasons that I am personally pretty optimistic for the market overall. But we want to be aware of what is scary, what's out there. So, number one, tariffs are just now impacting. So this is not a political statement. This is an economic statement. Tariffs are really bad for the economy. There's no way around it, and so this will lead to some pain for consumers and potentially corporate profit margins if they can't pass along all the impact to a consumer. We're just now seeing how this happens. So what you have on the left is just the stair step of tariffs increasing and tariff and excise revenue going up. 2025 is that really big number that keeps getting bigger. And then you see here on the right is just tariff revenues by month so far this year, and you can see that that's really starting to pick up. And so we have not seen this impact flow through the rest of the economic data, but it is something to be aware of that as this starts to play out, we don't know what that's necessarily going to be, but it can't be bullish. If anything, it's neutral or bearish, and so something to be aware of. We also are very aware of a weakening labor market. So the chart you have on the left is looking at the change in non-farm payroll and unemployment. And so you can see unemployment rate is rising, and basically the number of people employed is the change is decreasing. So we're still hiring more people, but it's slowing and getting really close to that zero number when you look a 3-month moving average of that change in non-farm payroll. And then on the right, not only are there's less people hired, there's just less job openings that are happening. So that's what the dotted red line is on the right, is just job openings over time, and then the employment rate as that picks up. So this is something to watch. From a stock perspective, AI sounds great, and there's a lot of investment that's really driving a lot of the earnings and profits going forward. But what does that do to the labor market? That's something I'm really aware of and thinking about. But also, as we just see the data, we are weakening in the labor market. So that will play out in some way, shape, or form. We don't know exactly what that will be. And then this chart that we have here is exactly the same as I had before. So I actually didn't change any of these numbers. So if you go back 3 months ago, we had a conversation about US equity valuations are really high, and that the only way that you can maintain this price or go from there is if earnings growth picks up, if you continue to have really good earnings growth going forward. Now, since I've had this conversation, the earnings growth has been higher than the consensus. It's been higher overall, which is really good for investors because we want earnings growth. But it doesn't change the story. And the story is this: companies have to continue to increase their profits, increase their earnings per share to maintain the current levels. And so when you have a higher price that you're paying now, a higher multiple, you need a lot of stuff to go right. And so as we're thinking about what could go wrong, there's a lot more downside potential if we have an earnings miss where companies are not growing at the same way, or they have an outlook that's a little bit negative. Any of those pieces could impact the market in a pretty dramatic way, and that's really all this is. So there's nothing imminent that's out there, but it is something to be aware of as we look ahead. And then the last one for our bearish chart here, it's just the U.S. debt levels. And so this is going back over time, and you can see how the debt has just continued to increase. This is becoming a story more and more. More clients are talking about it. More politicians are talking about it. It does kind of flow in and out through public consciousness of do we worry about that or not? Right now, it is what people are talking about. Um, it will only matter when it matters. The problem is we don't know when it will matter. And so at some point, we got to pay our bills. You have to take care of the debt that is continuing, with the interest payments and the way that things are. We don't know when that's going to matter, but it is something that's always kind of in the back of our mind on what's out there, what could go wrong. But on the flip side, there's a lot of really good reasons to be bullish, and I would argue that if you add all this up from today going forward, I'm still much more optimistic than pessimistic, at least as we look ahead the next 6 to 12 months on how we're investing. And so, number one, this might be counterintuitive, but the fact that we have what's called low consumer sentiment is really positive in my mind. So, here's the way I'd phrase it: during bull markets, as long as people are still worried, as long as people are still worried about what could go wrong, markets will continue to go up. I get scared when the fear of missing out, of missing the potential upside when everyone's optimistic, that's when I actually get worried. And you can see this in the data. So, what you see here is the US index of consumer sentiment. So, this is based upon surveys. What do you feel about your personal financial situation? How do you feel about the economy overall? And so we get the score. And so these are surveys that are done by University of Michigan over time. The gray bars on the screen are all recessions. So it's when things have gone wrong. And if you notice, almost across the board, the highest part where people are most optimistic is right before a recession. And if you just invested when we have very low consumer sentiment, and you map this to the S&P 500, you've got a lot of upside. So let's just go to the most recent great financial crisis. You've got this low point, you kind of you bottom out, and then things start to pick up, but they don't pick up a whole lot. And through the 2010s, if you talk to a lot of investors, they were worried. I have a lot of clients that came to us and they were sitting in a lot of cash before we helped them invest over that period of time. And it's because of this worry that you have. And then eventually it peaks, and it peaked right before COVID, and you see the big drop off. My point of this is, as long as people are worried, I want to stay invested because this is where valuations are still reasonable given what's going on in the economy. And there's a lot of investors on the sidelines, which is future money that will go in at some point. So that actually is maybe the biggest reason to be bullish, is the fact that a lot of people are bearish right now. Also, prices are going up for the S&P 500, but they're going up because earnings are going up. So we have record profit levels. And so this shows you a chart from January 1st, 2020 for the S&P 500 earnings up to today. And you can see that we bottomed out in the 90s in 2021. Now we're at 222. That is record profits. And you can see that markets going up substantially during the same time that profits are going up. So there's a reason that people are willing to pay more for companies. It's because they're making more money. Earnings, profits are synonymous. There's more money being made by corporations in the US than there ever has been. And you could argue that that will continue because over time we've had a lot of developments in technology and other pieces. Well, I also think there's better business leaders now that have learned from the past and are running businesses a little bit better. So you add all those pieces together, there's a reason why the S&P 500 is up a lot. And if this continues, very excited about it. So I mentioned the all-time highs. I wanted to show you this chart quickly. This is data from 1950 to 2023. And if you only invested at an all-time high, that's the blue. And so you look ahead 1 year out, you buy at a peak when it's an all-time high, which we're about 1% off of that right now. You average 11% moving forward versus 12.6. So it's a little bit less, but that's still really good numbers. If you only invested at all-time highs, you would average 11% 1 year out. You go 3 years, now you're at 10.9. You go a 5 year return, you're at 10.3 per year. So I'm happy to take 10% per year, even investing all-time highs or lows. I'd much rather pay less. If we had a crystal ball, that would be easy. But I'm not letting the all-time highs scare us. And actually, you take these numbers, these are higher than our long-term expectations are anyway. If we just recreate this of investing at all-time highs and have future returns in a similar manner, I think everyone who's listening to this will be happy. I also want to add in that we've had 3 recent corrections. So something I hear from a lot of clients and market pundits say this too is we haven't had a correction in a long time. The market just keeps going up. It just keeps going up. Well, what we're looking at here is the percent of the total stock market index off of highs. And I've circled 3 different corrections of about 15% or more that we've had. And you can see since January 1st, 2020, we've got 3 major drops where you've lost 20% or more 2 of the times and 15% the other in a very short period of time. And so I say this to say anyone that says we are due for a correction just isn't looking at the data. You've had 3 corrections in the last 5.5 years. You've earned the returns that you've gotten. Another way to say it has not been no free lunch. There's been plenty of volatility, and with volatility, we expect returns. You would not be willing to put up with the stock market volatility that we've had if you didn't also have returns on the back end. So there's no guarantee. But anyone who stayed invested during this time, just think back to where you were when during the COVID shutdowns or in 2022 when it was the worst year in 100 years for a stock bond portfolio and inflation was 9%. Or Liberation Day. I talked to some clients that next week that were worried we had too much money in stocks after it already dropped. And what I told them, and I'll tell you now, is stay invested through all this, and you've earned the returns that you've had. So don't feel like, oh, the next shoe has to drop. We are due for a correction. That's just not in the data in any way. And the last thing I'll say is you can see a lot of um, basically as it goes down, it comes back up. So if it's really fast going down, you can see that we're recovered to all-time highs in a similar fashion. In 2022, it was a little bit slower, it took a little bit longer to reach that bottom, but then once it turned and started going back up, about the same amount of time that it was going down, it went back up, and then the same thing here in April of this year. So all that's to say is even if we go through corrections, we know we will have some. Stay invested, maybe even buy some as things start to drop off. You'll be rewarded in the long run. Another reason to be bullish as we look ahead is the Fed is starting to cut and cutting to neutral. What you're looking at in this chart is looking at inflation versus the real federal funds rate, and essentially all this is to show you is there's a difference between that dotted black line. The core PCE is another term for inflation, one measurement of inflation, and then the real Fed funds rate is subtracting those two, and that our start is really where we think we'll end up over time. And so if inflation remains here at this level, then you got some room to drop with the Fed funds rate. If inflation were to drop back to the 2% target levels, then there's quite a bit that the Fed would cut to go down. But regardless, the Fed is currently going from um, current Fed funds rate to a more neutral rate. And if the labor market continues to deteriorate, I would expect them to go more accommodative and actually cut this even lower. And that's good for stocks. That's good for small companies that have a lot of debt that's tied to interest rates versus large companies that have a lot of cash, not a lot of debt that's out there. And so the Fed cutting rates should be good, especially for small cap stocks. That leads to kind of our last reason that I'm pretty bullish, is we have, for the first time in a long time, some small cap breakout potential. So there's a couple different charts that I could show you. We're just going to focus on this one here. This is earnings per share growth going forward. So you can see that we start in third quarter 24, basically get you through third quarter 25 of actual numbers. And again, the dark blue is the S&P 500. That's large cap stocks. The light blue is S&P 600. That's small cap stocks. So you can see large cap, really for the last year has had great earnings growth quarter over quarter, but the small cap has not. Well, now that's changed. If we look ahead to these estimated earnings, so starting fourth quarter 25 through fourth quarter 26, you can see that the light blue is really shooting up. And especially in 2026, the earnings expectation is 25% earnings growth for S&P 600 versus 17% for large cap S&P 500. And so if this actually happens, I would argue that small cap stocks are undervalued right now. The valuations aren't not nearly as high as that previous chart that I showed you. And so if you have this great earnings growth, we would expect some pretty good upside there for small cap. And so this is something that you'll see as we incorporate it into the portfolios, just the spread between large cap and small cap, how we're rebalancing. Part of that's just rebalancing as large cap outperformed. We didn't reinvest back in and bought small cap stocks. So part of the normal maintenance of the portfolio will take advantage of this, but it's something we're also looking at. Do we want to add a little bit more exposure to small cap stocks in anticipation of a breakout? You already had that. Small cap was the best performing stock asset class in the third quarter. And so it's already started to happen, but I think there's a lot more potential on the upside as we have it. So all that to be said, there are obviously things that we want to worry about. And I just focused on the economy and the markets and the way things are, and obviously everyone's got their own situation, own things that you're locally dealing with. But even with all that worry, even with all the things that could go wrong, I want to remind you there's always a reason to be worried. And part of investing is we want to make sure that any money that you have invested for the long run is truly for the long run. So you don't want to invest anything in stocks that you think you will reasonably need in the next decade. And the reason we set it up that way is we want to make sure that you can stick with it regardless of what happens, that you can take advantage of mispricings or when everyone else is worried, we can buy. We want to take advantage of all that. And I think that all of our clients are positioned in the right way, but I am not thinking that we're on the edge of a cliff, that things are just going to fall off, and we need to be worried from a stock market perspective specifically. Actually, I think there's plenty of reasons, as I touched on, to be bullish looking forward. So not a lot of changes that we're going to make, but I do want to make sure that we're all on the same page. Um, if you have any questions, if you want to talk about your specific situation, definitely reach out. We can talk through what this looks like for you and what specifically we're doing with your portfolio.